Mhm.
And I think between the time of that semester was the time when it went from being a great job offer to bankruptcy.
So bankruptcy.
That's funny.
Okay, so 6:05, so why don't we get started? So today is a special day because we have the first presidential debate coming up at 9 p.m. So I know a lot of people really wants to join the debate, watch how these two candidates think about the country, their prospects, and their plan for the country. So I'll try to make it as fast as I can so that you guys can watch the debate starting at 9 p.m. Okay? Nope. And then one housekeeping item that I want to go over is that, so I created this discussion board on my Blackboard. So far, only 2 students volunteer to introduce themselves and wanted to get to know you guys better. So hopefully a lot of students actually post their bios and introduction on this Blackboard. And one day might be, you guys might want to create this Zoom meeting, get to know each other with a video, okay? Any housekeeping items or questions you have before we get into today's lecture? Okay, I guess we don't have any questions. So let's get to chapter 5. So we talked about the journal entries at the end, at the point of the transaction in chapter 2, and we talked about the adjusting entries at the end of the year in chapter 3. Now, chapter 4 is on internal control that we're going to skip for now because I don't put much emphasis on this internal control, the separation of duties, all this, what do you call it? This system to make sure the accounting system properly works at the company. But you will talk about this internal control system and internal control audits when you actually go into this audit class, probably next semester or the semester after. Okay, so we're gonna skip chapter 4 and move on to chapter 5. So from chapter 5, the focus will be this. So we have balance sheet items, right? We have assets, we have liabilities, and shareholders' equity. So from chapter 5, we're going to talk about all sorts of transactions that affect each line items. For example, today we're going to focus on receivables. So that's accounts receivables or notes receivables. And definitely these 2 line items will be related to sales of goods and services, right? So we're going to go line by line according to the balance sheet and talk about different types of transactions that affect these 2 items for today. Okay, for chapter 6, we're going to talk about another mostly long-term assets. So we're going to talk about depreciations and goodwill intangibles next week. But for today, our focus is on this current asset section in the balance sheet. Okay. So if we don't have any questions, why don't we get started? Chapter 5. So recognizing accounts receivable. So we're going to talk about all sorts of transactions that are related to accounts receivables at the time of credit sales. So if we talk about cash sales, it's very easy. So at the point of the sale, we are going to debit cash by some dollar amounts, and we're going to record revenue by some dollar amounts. That's very easy journal entry. But if we move on to this credit sales, there are very different types of variations and transactions that affect your journal entry. So let's start with credit sales. So basically, at the point of the credit sales, the product or services are transferred to a customer, and as a company who are making these sales, you expect to collect cash in the future. Obviously, customers can use cash to pay for the services, or they can use credit cards to pay for the services. But our focus is on the credit sales. So like we discussed previously, when we see this term or expression called on account, that basically means the sale was made on credit. Okay, and it's obviously, I mean, if we go to Starbucks, we don't use cash, we always use credit cards. So it's very common in today's business transactions. Okay? So if the customer uses credit cards, as a company, you're recording accounts receivable. So basically, customers owe some money to a company in exchange for the services or goods. But keep in mind that at the point of the sale, when the company performs all the services or when the company delivers the goods to a customer, you are going to be recording this revenue according to the revenue recognition principles. Okay, we talked about this. We do not record a revenue when a customer signs a contract. In the example of Tesla, we do not record a revenue when the customer pays cash for a down payment. The Tesla company only records revenue upon the delivery of the vehicle to a customer. So according to this revenue recognition principle, a company must satisfy or must perform a reasonable and material services and goods to a customer in order to be able to record a revenue. Okay. So recording a credit sales, we talked about this. So when the company provides services to a customer for $500, the customer doesn't use cash to pay for the service, instead promise to pay, basically using a credit card to pay for the services. So at the point of the sale, the company will be recording debit accounts receivable by $500 and service revenue for $500. Very easy stuff. You should be very comfortable with writing this journal entry. So your question might be, how much can this be difficult, or how can you make variations with these types of transactions? And I say there are so many types of variations with respect to the transactions. So what is this? So companies record on assets, which is the accounts receivables, and revenue when they sell goods or services to their customers on account. They expect the collection in the future in exchange for the cash from customers. And once the receivable is collected, the balance of accounts receivable is reduced. So basically what that means is that at the point of the sale, you're recording accounts receivable, for example, by $500. You're recording a revenue by $500. At the point of collection from a customer, you're going to be debiting cash by $500, and you're going to credit accounts receivable by $500. So as a net effect, you are going to be basically eliminating or removing this accounts receivable. At the end of the day, what you're left is cash 500 and revenue 500. Okay. Any questions? Am I going too fast? Should be very comfortable with this. Okay, good. And there are other types of receivables according to the textbook. Here, the example shown is non-trade receivables. So that's receivables that originate from sources other than customers. So basically, we are mostly focusing on this manufacturing companies, but when actually, when there's a tax refund, or if the company lends money to another company or a bondholders, you are going to be recording some interest receivables. And also when a company makes loans to a company, you're going to be also recording this interest receivable. But I mean, you don't really have to know this term non-trade receivables, but just to know that whenever we talk about this receivables, that means the company it basically have some money to be received in near future. Okay. And there are notes receivable. So basically, whenever we see notes, you can think of it as a loan made by a bank. So, but in this case, since this is notes receivable, that means the company actually lent money to another entity or another company. So when after some time period, when the other company makes payment for the original principal, you are going to be reducing this notes receivable. But the prominent difference between this accounts receivable versus notes receivable is the time period. I call it time period. So whenever we talk about this accounts receivable, we usually talk about the money to be received within 30 days or 60 days. But for notes, it usually lasts longer than 6 days. Okay, so for longer terms, it could go years for notes, but this is basically this criteria. I don't want to say criteria, but the agreement among the accounting professionals that when we use accounts receivables, that basically means the company expects to receive cash or collect cash within 30 days or 60 days. Whenever we talk about notes, we usually expect to receive or collect cash beyond 60 days, or it can go even years. Okay. So which of the following generally is recorded at the time a company provides services to customers and accounts? So basically, when the company provides services, you are going to be recording accounts receivable. Rarely is the case that the company will record notes receivable, because I mean, whenever we talk about credit cards, we usually pay back next month. So that's usually this accounting item, accounts receivable, that we use in order to record the receivables for the company instead of notes receivable. Okay. Any questions so far? Okay. So at this point, I'm going to be introducing variations with respect to these transactions affecting accounts receivables and sales. So here in the real world, if you go to, let's say, Neiman Marcus or Macy's, a lot of customer actually makes returns. And then there are some allowances. So whenever we talk about allowances, you can think of it as a product. That product has some defects or some problems with the product that the customer representatives will provide some discounts because of this defect that the product has on. Okay. And for discounts, some companies provide discounts for various reasons. So from this slides, we're going to talk about these different types of transactions and how you are going to be recording a journal entry for respective transactions. Okay. So let's first talk about trade discounts. So when we talk about trade discounts, is that the company will reduce the listed price of a product or the service because the customer is buying in bulk. So slide 11, whenever we talk about trade discounts, we talk about a customer buying products in bulk or in large quantities. quantities. Okay, so obviously, as a company, if a customer buys this product in a large quantity, you can expect to provide some discounts as a reward for buying in large quantities. Also, another types of trade discount is the discount given to certain groups. So in this case, senior citizens, military discounts, or even student discounts. So certain groups of population will receive discounts based on their age, based on their occupation. So whenever a company gives discounts to these certain groups of the population, they are going to be treating this as a trade discounts. Okay. Now, what's interesting is that, so for example, here, this eye surgery is $3,000, but the company decides to give a special offer or special discounts because maybe the customer is a senior citizen or serving in the military. So basically, the company is giving 20% discount. If the company decides to give a 20% discount to this particular customer, what you're going to be recording is debit accounts receivable by $2,400 because basically the original price is $3,000, multiply that by 80%. So that's $2,400, and you're going to be recording a revenue of $2,400. Okay. So for trade discounts, you are going to be reducing your revenue as well as your accounts receivable by the respective discount percentage. Okay, that's easy stuff. Nothing fancy. Okay, any questions with respect to the trade discounts? Okay, so that's good. Now it gets more complicated. I'm going to skip a few slides. So this was an example of a trade discount, but there is another types of discount, which is sales discount. Slide 16, sales discount. Now, sales discount is a whole different story. So basically, what sales discounts is that a customer receives a lower payment terms if the customer decides to pay early. So an example given here is this term here. So what that means, 210, comma, and 30. What this means that if the company pays back within 10 days, the company will give or provide a 2% discount. Okay. Otherwise, you are obligated to pay me back within 30 days without any discounts. Okay. So again, if the customer decides to pay within 10 days, they will receive a 2% discount. Otherwise, the customer is obligated to pay within 30 days without any discount terms.
I'm sorry, Professor.
Yeah.
What's that below 2%?
2%. Yeah, 2%.
No, what's below it? Sorry.
Discount. So
Okay.
D/C. Okay.
Professor,
Thank you.
are those terms always written in days? For example, could it be in months, or is it assumed?
It could be months or even years, but again, we're talking about product sales or services that the customer usually pays within, a month.
Gotcha.
And then we're talking about accounts receivables rather than notes receivables. So for this course particularly, we're going to talk about these terms in days.
Gotcha. Thanks.
Mm-hmm. Mm-hmm. Any other questions?
If you get a discount because of paying cash, is that?
Yeah, of course. Any other questions? Okay, so the example given here is that the customer owes $2,000, for example, we don't know whether it's a goods or services or whatever. The customer owes $2,000 to a company. The terms of the payment is 2/10 and /30, and then assuming that the service was made on March 1st. So let me do another slide. So on March 1st, okay, what the company will be recording is accounts receivable, okay, by $2,000, and service revenue or sales revenue by $2,000, okay? At the point of the sale, the company does not know whether the customer will pay within 10 days or within 30 days. So we don't know at the point of the sale. So this is the journal entry that the company will be recording. Now, case 1. If the customer decides to pay back, let's say on March 10th, which is within 10 days. So March 10th, what the company will be recording is this. So since the customer will receive 2% discount, they will only pay back this $1,960. So that number comes from 2,000 times 98%. Okay. So a customer will only pay back $1,960 after subtracting this 2% discount. Now, but you originally recorded this accounts receivable at $2,000. Okay, so you're going to be reducing this original $2,000 by crediting it. So we end up having this $40 difference. So we're going to be recording that as sales discount. Okay, to balance the debit and the credit side. Okay, so now you see, so for trade discounts, when the customer receives a discount, we reduce this revenue directly, as you can see right here. But for sales discount, we do not reduce the original revenue amount. Instead, we are going to be recording this contra revenue account in order to reduce the original revenue of $2,000. Okay, so that's the difference. For trade discounts, you are going to be directly reducing the original revenue, whereas for sales discounts, you're going to keep the original revenue amount, but instead you are going to be adding a contra revenue account called sales account to reduce the revenue, the net revenue amount. Okay. Any questions on this journal entry?
Is a sales discount, is that an income statement item?
Yeah, it's an income statement item. So in the income statement, so whenever we talk about income statement, we're starting with revenue by some dollar amounts. We're talking about expenses by some dollar amounts. But in reality, what you are going to be seeing is revenue, and then you are going to be seeing some sales discount underneath by some dollar amounts. And then you are going to be seeing net revenue of dollar amount.
Thank you.
Mm-hmm.
So wait, one of them, you have a contra account. What's the one where you don't have a contra account?
That's for trade discounts. So again, so if we go up, so for trade discounts, so a company is giving discounts to a certain groups of population or to a customer who are buying in large quantities, you directly reduce this revenue, okay, when you're recording the original journal entry. But for sales discount, you're going to keep the original revenue amount at the point of the sale. But when the company receives or collects cash from the customer, you are not going to change this original revenue amount, but instead you're going to be recording this contra revenue account called sales discount to basically account for this discount given to a customer. Okay. Any other questions? So a question here, is there an adjustment in inventory? Is there an adjustment? Yes, there is an adjustment in inventory. We're going to talk about that in chapter 6. So we're going to talk about the lower, let me write it clearly, lower of cost or market method. So we're going to talk about this in chapter 6, but basically there is an adjustment for inventory. Okay, but that's for another chapter. Any other questions? Okay, so again, so at the point of collecting cash from a customer, if the customer decides to pay within 10 days to take advantage of this 2% discount, you're going to be receiving only $1,960, subtracting $40 as discount, but you're actually reducing the entire $2,000 of accounts receivable by crediting it. Okay, and again, the sales discount is a contra revenue account that reduces the original revenue that's reported originally. Okay. So as an example here, in the income statement, you are going to be seeing this original sales service revenue and then sales revenues, but because of the returns, because of the discounts, because of these allowances, you are going to be reducing it. And at the end of the day, you have this net revenue of $1,960. Okay. So let me just go back to here. Okay. So far we talked about trade discounts. We talked about sales discounts. Now, there are other types of transactions, so sales returns and sales allowances. So obviously in the real world, a lot of customers comes back to the store and then they return goods or products that they previously purchased. And if the customer returns its goods, the seller or the company will issue a cash refund or a credit refund, depending on the types of payment that the original transaction was made on. Okay. Now for sales allowances, so what's the difference between the sales return and sales allowance is that for sales return, the company will receive the product as a return. Whereas for sales allowances, that's an example of a product defect, or let's say a shoes having some dirts on it. So if you're buying shoes and have some dirts on it, you might, if you're a nice customer, you're not gonna ask for any discounts. But someone like me, if I see shoes that have a dirt on it, I might ask for some discounts because of this problem. So in this case, the customer will keep the original item, but instead they will enjoy some discounts associated with it. Okay. But again, the seller issues a cash refund or credit refund depending on the payment method. Okay. So how do you book that entry? How do you record that entry? So again, so when the customer comes back to store and makes a return, let me write here. So again, original transaction will be, we don't know the original transaction. Let's assume that it was $3,000. So you're going to be recording this accounts receivable, $3,000, and service revenue, $3,000. That's the original transaction. But when the customer comes back to a store asking for a refund for the return, oh, in this case, oh, so if it is a return, it should be the same price. Sorry, $200, $200. You are going to be recording a sales return, okay, by $200, and accounts receivable, $200. So basically, if the customer returns the product, you don't have any receivables in the future. So basically, you are deleting the receivables. And basically, originally you recorded a revenue, but because the customer made a return, you are end up having zero revenue, zero net revenue in the income statement. Okay, but again, for these sales returns, you are not going to directly reduce the original revenue amount, but instead you are going to be recording this contra revenue account called sales return in order to reduce the original revenue. Okay.
Professor, I have a question.
Yeah.
So we're crossing out accounts receivable on both parts because of the sale return, right? And that should be indicated in the journal, like the crossing out.
I mean, I'm just crossing out these accounts receivable to show you that you don't have any receivables. But in the system, in the accounting system, you don't actually cross out. You actually record all these to keep the record of it.
Thank you.
Uh-huh.
I have another quick question.
Sure.
If the customer pays cash, is it still credited to accounts receivable or is it credited back to cash?
If the customer uses cash, there's no receivables in the first place. You're not going through these hassles.
So it's back to cash.
What was that?
Sorry. It's just credited back to cash.
Oh, okay. So, I mean, so in this case, we are assuming the customer uses credit cards. So let's use cash transaction. So if the customer, if the customer uses cash to pay for the service, you're going to be recording cash, 200, revenue 200, right? When the customer returns the product, you are going to be recording sales return by $200, and you're going to give back cash, right? $200.
Okay, thank you.
Yeah.
Hello, Professor.
Yeah.
So if they are selling eyeglasses, right? There must be an impact on cost of goods sold, right? Is there, like, when they return, how would they put a journal entry?
We're gonna talk about that in chapter 6 or chapter 7. I forgot, but that's another complicated story that I don't want to get touched on.
Got it.
Yeah. Any other questions? Okay. So, and then one more thing was a sales allowance. So sales allowance is when the product has some defects. Okay. But I mean, the idea is very simple or consistent. So originally you're going to be recording accounts receivable by $400 and sales revenue $400. But because the product has defects, the customer comes back and asks for these allowances for defect. So as a company, you're going to be recording sales allowance by $400 and accounts receivable by $400. Again, for this sales allowance, instead of directly reducing the original revenue amount, you are going to be adding or using this contra revenue account called sales allowance to reduce the original revenue transaction here. Okay.
Is that like when you think of a contra account, I'm thinking of it as a negative revenue? Is that?
Well, you can think of it as a negative revenue given here. So you had the revenues, and because of the returns and allowance and discounts, these are basically negative numbers.
So it's a debit on an account.
It's a debit item because revenues are credit balance items. So these contra revenue accounts items are debit balance items.
Under owner's equity.
Yeah. Or retained earnings or net income.
Thank you.
Yeah. Any other questions?
Professor, so for all the services, if a customer comes back it has to be sales allowance, right? Because you cannot return the service. So if the customer come back for a discount, it has to be, there's no sales return.
Yeah, I mean, depending on the transaction, whether the customer is returning a product or asking for discounts or some reduction in amounts that they owe because of the product defects, depending on the transaction, you're going to be using sales allowance or sales returns. It's, again, last week we talked about the interpretation, right? I mean, depending on how you interpret that transaction, you are going to be using sales return or sales allowance. I mean, I'm not really picky about this account line item names here, but just to know that these sales returns and sales allowances and sales discounts, these three line items are contra revenue accounts that reduce the original revenue amounts. That's all you need to know. Okay. Another thing is that so far we talked about sales returns, sales allowances, and sales discount. We do not see trade discounts here because, like I said previously, for trade discounts, we directly reduced the revenue right here. Okay, that's the only difference between trade discounts versus all sorts of contra revenue accounts. Okay. Any questions? Okay. So that's good. So basically this slide shows that you are recording this accounts receivable of $2,400 for the services, but this sales returns and sales allowance and sales discounts will reduce these accounts receivable, so they are recorded on the right side. So ending balance is 0. Okay. So I'm going to read out this loud. The discussion above deals with how companies record contra revenues. So contra revenues, we talked about sales returns, sales allowances, and sales discounts during the year. The company also must adjust these amounts at the end of the year using adjusting entries. So what basically means is that at the end of the year, December 31st, let's say 2020. At the end of the year, you are going to be having some number for accounts receivables, okay? So let's say originally you had accounts receivable of $2,400. Now, because of sales returns or sales discounts or sales allowances, let's assume that these are all $500. So at the end of the year, you are left with a net accounts receivable of $1,900. Okay. Now, at the end of the year, you might have to adjust this number, okay, because of all sorts of possibilities. For example, the customer becomes default, where the customer declares a bankruptcy. So if that's the case, how would the company would adjust this remaining accounts receivable? That's the question that we're going to be discussing going forward. Okay. So the effect of a sales allowance will result in which of the following? So basically, sales allowance is a contra asset account that reduces the revenue. So if you're reducing a revenue, obviously you're going to be decreasing the net income. Okay. Any question on this? Okay. Another problem. Which of the following computations would be used to compute net revenue? So I've shown you an example here. Let me just go up. So the items that are going to be reducing revenues are these contra revenue accounts, sales returns, sales allowances, and sales discounts. So going back to the problem, so this sales discounts, sales allowances will reduce the revenue. You do not change the net revenue. You're starting with the total revenue, and then you make some adjustments using contra revenue accounts. Okay. Total revenue, accounts receivable, I don't even know what they're talking about. This is an income statement item. This is a balance sheet item. So there's no connection between these two. I don't even know what this is. Okay. So again, in order to compute the net revenue, you're going to be starting with the total revenue, and you're going to be making some adjustments for sales discounts and sales allowances in order to get the net revenue. Okay.
Wait a minute. That the slide C says total revenue minus sales discounts. Shouldn't it be net revenue is total revenue minus sales discounts and sales allowances?
So basically, you have the original revenue, which is total revenue. Let's say 1,000. And there are going to be contra revenue accounts. So sales return or sales allowances. Let's say these are 500. Okay. So at the end of the year, you are going to be reporting this net revenue of $500.
Yeah.
Okay. So this is what you're showing. So you're starting with total revenue. You're going to be deducting or subtracting these contra revenue accounts in order to get net revenue, to compute the net revenue.
Thank you.
Professor, I just have a quick question about slide 17.
Slide 17. Okay.
I may be I might just be really out of it, but what is sales revenue from?
Sales revenue from?
Yeah, in this income statement.
So I think the example is maybe I deleted that. So basically, it's on. I don't know. It could be any transaction that are making sales that a company is making.
Okay, thank you.
Yeah. I mean, if you are a company, there are going to be transactions related to providing services. There are going to be something related to selling products. So for example, if you're an Apple company, we talked about this last week. If for Apple company, iPhone sales are going to be related to the sales, but at the same time, Apple company is also reporting a revenue related to services. And the examples was iCloud services. What else? This iCloud. I forgot the others. But these are not products. These are services. Okay. So for one particular company, there are going to be revenue transactions related to product sales. There are going to be transactions related to service revenues. And this is what it is showing here. Okay.
Thank you.
Any other questions? Okay. So far, we talked about sales part. At the point of the sale, how is the company going to record the sales and how the company will adjust those sales with respect to the revenues. Now, again, but at the end of the year, the company will report accounts receivables basically due to this revenues. But at the end of the year, the company has to evaluate the validity of this accounts receivable amounts, because it is very possible that some customers declare bankruptcy, some customers becomes default, and that accounts receivable will be uncollectible in the future. So based on this historical record, based on some models, or based on this industry standards, they are going to adjust, or they're going to change this accounts receivable for various reasons, and that's what we are going to be discussing from slides 22. Okay. So for this part, what you need to understand is that some accounts receivable will not be collected, again, because of the possibility that the customer goes bankrupt or declares default. So according to US GAAP, companies are required to estimate future uncollectible accounts. So again, if the company estimates future uncollectible accounts, what that means is that you are going to be reducing this accounts receivable by some dollar value or dollar amounts. Okay. And then if you are reducing this accounts receivable, that means you are reducing assets, and as you are reducing assets, you are incurring an expenses. We are going to be using this bad debt expense to reduce the accounts receivable here. But you don't have to really know this at this point. When we talk about the journal entries, you will understand what I mean by using this bad debt expense. Okay. But what you need to know at this point is that when we are estimating this uncollectible accounts, we are reducing accounts receivable. In other words, that means we are reducing assets, and at the same time, we are going to be recording this bad debt expense. And since this is an expense account, that means the expenses are increased. In other words, the net income will decrease at the end of the year. Okay. So this is basically the process. Okay. At the end of year one, for example, year one, okay, you are going to estimate collectible amount, dollar amount. So for example, let's say you have an accounts receivable of $10,000, or $10,000, let's say. So you have some receivables of $10,000. Now, historically, the company expects that 20% of accounts receivables, or some receivables, are uncollected because of various reasons. Okay. So what that means is that instead of reporting this $10,000, the company is required to report the accounts receivable, the net amount of $8,000. This is the number that's more relatable, that really reflects the economic value of accounts receivable instead of this $10,000, because historically the company experienced that about 20% of the receivables are uncollected in the future. That's what's happening right here. Okay. Now, so if the company expects is 20% of uncollectibles, there are going to be journal entries, obviously, okay, to report that. Should I want to go over this? No, I want to go over this in the next slides. But again, so basically you have, okay, $20 million $20 million of accounts receivables at the end of the year. But because of the experience, because of this historical records, we should, or the company should report this allowance to reduce the accounts receivables, okay? That's what we are going to be focusing on from slides 25, okay? And obviously there are different types of models, there are different types of methods to estimate this exact dollar amounts, and we're going to be talking about that soon. Okay. But any questions so far? Okay, good. So let's go to the journal entry. So at the end of 2021, the company is owed, or the company has some receivables of $20 million from customers, and the company estimates that 30% of it is not going to be collected. Okay. So when at the end of the year, the company will report an adjusting entry, okay, the adjusting entry, which is 26, which is the debit bad debt expenses of $6 million. Now that 6 comes from this 20 million, okay, original accounts receivable times 30%. Okay, that's the debit side. On the credit side, you are going to be recording this allowance for uncollectibles. Okay, collectible $6 million. This is the journal entry you're going to be recording. Okay, now similar to the sales allowance story, when we are estimating this uncollectibles, okay, so that number, the company expects that we're not going to be collecting this $6 million. We do not reduce the original accounts receivable by 6. We do not reduce the accounts receivable. We do not touch the original accounts receivable. Instead, we are going to be recording this contra asset account to reduce the original accounts receivable. Okay. So going forward, there are going to be a lot of contra revenue, contra asset accounts to basically reduce the original amount for their respective account line item. Okay. But again, the idea is that at the end of the year, after estimating the total amounts of uncollectibles, the company will report debit bad debt expense of $6 million and credit allowance for uncollectible accounts by $6 million. Okay. Now, since this is an expense account, that means that the net income will be reduced by $6 million due to this adjustment, and because of this allowance, your assets will be reduced by $6 million. Okay. So bad debt expenses reported in the income statement. If you're reporting an expense, your net income will be reduced. Allowance is a contra asset account. So if you are reporting a contra asset, that will reduce the accounts receivable. In other words, that will reduce an asset, total assets. Okay. Any questions on this? Okay, so after recording this adjustment, or after recording this journal entry of uncollectible items, what you are going to be seeing in the balance sheet is that here you have an original accounts receivable of $20 million, and beneath accounts receivable, you have allowance line item by $6 million. So you have an accounts receivable net amount of $14 million. This is what you're going to be seeing in the balance sheet. Okay. Any questions on this? Whoa. Okay, so that's good. So under income statement, because of this bad debt expense, you had the revenue, but under expenses, you are going to be reporting this bad debt expense of $6 million. That reduces the revenue, and that affects the final or the net income at the end of the year. Okay. I do not think I have a balance sheet illustration, but basically balance sheet illustration is this. You have this accounts receivable of $20 million. You have a contra asset account called allowance for uncollectibles for $6 million. And at the end of the year, you have a net accounts receivable of $14 million. Okay. Common mistake. Because allowance for uncollectible accounts has a normal credit balance, students sometimes misclassify this as a liability. I don't know whether you are going to be thinking allowance as a liability, but it's not a liability account. It's a contra asset account. Okay, this is a contra asset account that specifically reduces this accounts receivable under assets. Okay. So which of the following is true regarding allowance for uncollectible accounts? This is not a liability account. It's a contra asset account. It is added to the total of sales. Okay, this has nothing to do with sales. Okay, it only has to do with accounts receivable. It is subtracted from the balance of accounts receivable in the balance sheet. So this is what it is. So this allowance is subtracted from the original accounts receivable. Okay, it appears in the balance sheet. Okay, allowance is reported in the balance sheet. What's reported in the income statement is the bad debt expense. Okay, not allowance. Okay. Now, so far, what we were discussing is estimating. Okay. Estimating uncollectibles. Okay, collectibles. So far, it was just an estimate based on some historical records or some models or method used. Now, what happens if the company actually finds out that the customer cannot pay? So in other words, what happens when the company actually write off the uncollectibles? So there's a difference. So far, we have been discussing the estimation of uncollectibles at the end of the year. Now, in the next period, the company will find out whether that estimate amount is truly uncollectible or not uncollectible. So basically means collecting in the next period. So for the first part, we're going to be talking about the actual write-off, okay, of uncollectibles. So when it becomes clear that a customer will not pay due to defaults or bankruptcy, the company write-offs the customer's accounts balance as uncollectible. Okay, so this is what we call a write-off. Okay, so let me just show you the journal entry. Maybe journal entry is more easier to understand. So far, let's say year one. At the end of year one, the company records a bad debt expense of $10,000. an allowance for uncollectibles of $10,000. Now, this was based on the estimation, okay? Based on the estimation. And during year 2, the company finds that out of $10,000, the company finds that $4,000 are not collectible for sure. Okay, now what's the journal entry for that? So journal entry is allowance, okay, for uncollectible by $4,000, and then you are going to be recording the credit of accounts receivable by $4,000. So what's happening here is that at the end of last year, you estimated that $10,000 are not collectible. And in the next year, the company finds out that $4,000 is not collectible for sure. So this is not an allowance anymore. This is like 100% for sure. So what you are going to be doing is to report a debit of allowance because this $4,000 is definitely not going to be collected. And at that point, this receivable is no longer receivable because the company is writing off. So you're going to credit accounts receivable by $4,000.
It seems like when you a credit to allowance for uncollectible accounts is the realization of the actual loss.
It's not a realization. It's an estimation. Again.
Well, what did you say the 4,000 was?
$4,000 is the recognition or the realization actually. Because at that point or during year 2, this $4,000 is the company realizes that this $4,000 is not collectible for sure, 100%.
A debit to an allowance for uncollectible accounts is it the realization or the recognition? What are you saying?
I mean, at this point, it's basically the same thing. The company realizes that the $4,000 is not collectible, and that's why the company is recognizing this $4,000 by debiting allowance.
But the credit is estimation.
This is an estimation.
Okay.
Yeah. Okay. So how do I make it easier? So you have accounts receivable right here. This is a debit balance item, right? This is an asset. By estimating the allowance, this is a credit balance item. Allowance is a credit balance to reduce the original accounts receivable. Now, during the year, okay, the company realizes that $4,000 is not collectible, so this is not an allowance anymore. So what you are going to be recording is, oh my God, pet mode. Is by debiting allowance, you are reducing the estimation, and then you are going to be reducing the original accounts receivable by crediting it here. A lot of things are going on, but just know the sequence of it. At the end of the year, you're going to be estimating uncollectibles, and then you are going to be recording this allowance by the respective amount. During the year of year 2, when the company realized that certain amount of dollar amounts are not collectible, you are reducing the estimation by debiting allowance, and at the same time, you are actually reducing this accounts receivable because that receivable is no longer viable. Okay. Any questions on this?
Sorry, just to double check, we're crediting accounts receivable to reduce it, right?
No, debiting account. Oh, yeah, crediting accounts receivable by reducing it.
Thank you.
Mm-hmm. Any other questions? So, it's not moving. So this was the end of year 1. You had an estimation. During year 2, you realize that some amount is not collectible, and you repeat the same process. The end of year 2, you're again are going to estimate the uncollectible based on the model. Now, there are so many questions. So, hey, professor, what about the remaining $6,000 in the bad debt expense that was recorded? $6,000. There's no $6,000 bad debt expense. Are we going to true up this account in the subsequent year? Now, for the first question, if everyone, I don't know whether I can copy this. So the question is, what about the remaining $6,000 in the bad debt expense? There is no $6,000 bad debt expense. You only have this $10,000 bad debt expense that was reported at the end of year 1. You do not make any changes, or you do not make any adjustments with respect to this bad debt expense. Okay. It would still be in the allowance for, I don't know what this means. No problem. Okay. So again, so we are making adjustments with respect to this allowance, but we do not make any adjustments for the bad debt expense. Okay. Any other questions? Okay. So when the company is writing off, okay, when the company write-offs, you are going to be decreasing a contra asset. So what that means is that you originally had this contra asset account. At the point of realizing that the sum amount is not definitely collectible, you are going to be decreasing this contra asset account by debiting allowance. And at the same time, you're going to be decreasing an asset. You're going to be decreasing accounts receivable because you no longer have receivables for sure. Okay? So net effect on total assets is 0. So what that means is that, let me show you here. So let me just provide you an example. How should I do this? So let's say before and after analysis. Let's say you originally had accounts receivable of $10,000. Okay. And then you had an allowance of $4,000. Okay. So at the end of the year, you have a net accounts receivable of $6,000. Okay. Now, during year 2, okay, let's say you write off $1,000. Okay. The journal entry for the write-off again was debit allowance 1,000, accounts receivable 1,000. Okay, this is the journal entry for the write-off. So after an adjustment, what happens to the original accounts receivable? Before the write-off, it was $10,000. After write-off, we are reducing by 1,000. So the new or the updated accounts receivable becomes 9,000. Okay. This allowance originally was 4,000, but we are going to be reducing 1,000. So that new allowance or updated allowance becomes 3,000. So after the write-off, the net accounts receivable stays the same at 6,000. And a lot of students actually make a mistake here. Okay. So the net effect or the total, I don't want to say total assets, but the net accounts receivable before and after the write-off stays the same, because what you're essentially doing here is that you are reducing the top part and the bottom part by the exact same amount. Okay, this is something that a lot of students are confused. But any questions on this? Okay, that's good.
Well, I
No,
have
go
a
ahead.
quick question.
Mm.
What happens to the allowance account at the end of the year? Does that get cleared out?
Oh
Or
no, it
how
stays.
do you-
So this is a balance sheet item, so it stays there. It doesn't, you're not converted to zero, like an income statement item. This is a balance sheet item. Whatever happens in the balance sheet stays the same.
Okay, so it's an allowance until you realize that you definitely can't collect it, at which point you write it off.
Mm-hmm. When you write off, you're going to updating your allowance, but that number will be reported at the end of the year.
Okay, thank you.
Another question?
Just a question. Oh wait, where does the bad debt expense go in here? Where like it doesn't affect this part?
Bad debt expense?
Yeah.
I mean, we're talking about this balance sheet items. So all these are balance sheet items. Bad debt expense is an income statement item. So at the end of year one, when you are estimating, you're going to be reporting this bad debt expense of $10,000. That's it. You don't make any adjustments or you do not make any changes with respect to the bad debt expense.
Professor, following on that, right? So let's say on year two, beginning of the year two, well, the person, like his business got better and paid you the money back. What will happen to the bad debt expense?
Yeah, well, we're going to be actually talking about that here.
Oh.
So, yeah. But any questions before we move on?
How do you do a end of the year entry for the bad debt expense then? Because that has to go to zero because it's
year-end journal entry. That's it. That's it. This $10,000, a debit bad debt expense. That's it. You do not, again, you do not make any changes. You only report this $10,000 under expenses in the income statement. That's it.
But don't your expenses have to go to zero?
Oh, when you're closing the book.
Yeah.
Then you're going to credit this bad debt expense to convert to zero.
Against what?
Retained earnings. So.
Oh, okay.
Yeah, for closing entry. So this is a debit balance item. So when you're closing the book, you are going to be reporting debit retained earnings, $10,000, and bad debt expense credit, bad debt expense, $10,000. This is the closing entry. Okay. Any other questions? Okay. So following up from the previous slide. So what we have been talking about is the journal entry for the write-off. Now, in some other instances, the customer decides to pay back, even the company wrote off. Now, that can happen in the event of a proceeds. So let's say the customer declares a bankruptcy or defaults. Oh my God, my handwriting. Defaults. So when the customer defaults or declares a bankruptcy, all the assets will be liquidated. This is the term we use, liquidated. So if the assets are liquidated, there will be proceeds. Okay, proceeds, or in other words, cash, by selling those assets. And sometimes the seller company will receive these proceeds because basically this customer owes the seller company some money. Okay, so sometimes the company who is selling this product will collect previously written off uncollectibles. Okay, so there are 3 steps going on, but that's basically it. So sometimes companies collect this accounts receivable that was previously written off. So in that case, what you are going to be doing is this. Let me start with the write-off journal entry. Write-off journal entry. For the write-off journal entry, you are debiting, oh my God, allowance by X amount, accounts receivable by X amount. This was the write-off journal entry. Now, what if you are collecting previously written off? Okay, written off accounts. So that means you have to reverse, okay, the write-off journal entry and then record the cash receipt. Cash receipt. So what I mean by reversing the write-off journal entry, you had a debit of allowance, you had a credit of accounts receivable. So you are going to reverse that. So you are going to debit accounts receivable by some amount. You are going to credit allowance by some amount. And then you are going to record this cash receipt. Cash debit by some amount, and then accounts receivable by some amount. Right? Gets very complicated. But essentially what we're doing here is that since we are collecting cash that was previously written off, you have to reverse the original write-off journal entry, and then you are going to record this cash receipt. So the original write-off journal entry was debit allowance, credit accounts receivable. So by reversing it, you are going to debit accounts receivable, credit allowance, and then you are going to record the cash receipt by debiting cash and then reducing accounts receivable by crediting it. Okay. Any questions on this?
Yes, I do.
Yeah.
I have a question.
Yeah, go ahead.
Okay, so my question is, so it looks like the net impact is that I had generated an expense, a bad debt expense, right? I estimated, I created an allowance account, and now I written off, and then now I'm collecting that portion of that expense that I had written off, right? So now here we're creating a cash receipt against an allowance. We're reestablishing the allowance for uncollectible accounts. That part, I don't understand that part. I would think that it's probably like, I would probably credit either the expense account because some of that expense that we have recorded now needs to be reversed out because we have collected, or some sort of revenues, or reversing out, or putting the original revenue back.
So I guess your question comes from this. We are doing all this complicated process for balance sheet items, this allowance, accounts receivables, and cash collections. What about the income statement item that we originally reported here, bad debt expense? Why don't we make any changes or adjustments with respect to this bad debt expense?
I guess my question really is, I kind of disagree with or I don't understand it. Why we're creating a balance in the allowance for uncollectible accounts, because this is now a new balance that we're going to carry forward forever. It's not a reversal. It's creating a balance. And I would think instead of creating an allowance for uncollectible accounts, which is no longer uncollectible because we did receive it now, now we should have recorded some sort of income statement item, either reduce the expense or record the revenue.
Just because you're receiving cash, it doesn't mean it's a revenue, okay? You already reported the revenue in the original transaction, okay? Now, at the point of reporting the revenue, you are reporting an accounts receivable. Now, what we are discussing so far is that for that accounts receivable, there has to be some adjustments because it is understandable that some accounts receivables are not collectible, okay? Now, because of that, we're making all these adjustments and journal entries to account for these changes with respect to the accounts receivables. That's it. I don't.
I'm with you so far. So, like for example, like the chain that I'm trying to create is that originally we created we have a revenue. We recorded a revenue, and then the next step is that we recorded uncollectible allowance account, right, which is a bad debt expense. So, but now we received a portion of that expense that we have created in the past. So shouldn't we not reverse out some of that expense that we over accrued for that expense?
So again, so I guess your question is that we're doing all these adjustments to allowance. Why not make any adjustments with respect to the expenses? Why not reverse it as well?
Or creating a new balance in the allowance.
Yeah.
Now we're actually creating a new balance in the allowance for uncollectible accounts, right?
Yeah.
I have a thought.
All right, that's the part I'm not understanding.
Now, how should I answer this?
I have a question that might answer that question, which is, at the end of the year, I think you look at your total allowance and all of your accounts receivable. So it would wash through at that point. So you look at all your accounts receivable and you see how much of it you think is bad. So because you've added in some allowance back in from things that the write-off had to be reversed, then you can expense less the following year. Is that the case? Because you look at it cumulatively, don't you?
Let me think. Whoa.
I think yeah, I think
I mean, so basically we are crediting allowance, we are debiting allowance, we're again crediting allowance because of the write-off, because of the collection of the previous written off. You're saying we originally had bad debt expenses. Why not credit expenses when the company collects cash? Your question is basically this, right?
Yes, that's correct. Instead of creating the allowance, or why not the expense?
Yeah. The only answer that I can give you is that this is how the accounting professionals came to an agreement to basically explain this write-off or uncollectibles or collecting what was previously written off. This is just an agreement. This is not a rule. This is an agreement. This is an interpretation. If you think that some amount of expenses should be credited because of the collection or because of the write-off, you might do this, but when auditors comes in, they will say this is not how you are supposed to do it. Again, this is just an agreement among professionals. Now, another point that I want to make is that accounting profession or accounting discipline is all about conservative approach or conservatism. So what we mean by conservatism is that accounting professionals always prefer numbers in lower amounts, okay? We do not want to overstate anything, okay? Overstating is bad, basically, in accounting. Or understating is good. This is what we mean by conservatism, okay? Now, we make all these adjustments for allowance, okay, because of this agreement among professionals. Now, if you are crediting this expense or basically reducing expenses, that means your net income will increase, right? Accounting professionals do not want this, do not like this, because we always go for this conservative approach that overstating is bad and understating is good. This may be the answer to your question as to why we make all these adjusting entries for allowance, whereas for bad debt expenses, we do not record any adjustments. Okay.
I a question that doesn't that would it's still revenue, isn't it? And how does this not throw the balance sheet off?
I lost the connection. What was your question again?
I just don't understand this. Sorry.
You don't understand which part?
If you've written it off, and then you collect on this money that you've written off, I don't understand how that's
you don't
not,
understand. So basically,
yeah.
Okay, let's just do a time trend here. December 31st, let's say 2020, December 31st, 2021. Okay, so at the end of the year, you are going to estimate uncollectibles, okay, because some customers do not pay you back because of various reasons. At that point of estimation, you are reporting, oh, what's going on? Bad debt expenses and then allowance for uncollectibles. Okay, that's what you're going to be recording at the end of year one. Okay, you're estimating. Now, during the year of 2021, the company realized that some customers actually default. So at the point of default, the company will write off. Okay, write off accounts receivable because the company now knows that you're not going to be collecting that money. So at the point of the write-off, you are going to debit allowance, okay, allowance, and you're going to reduce accounts receivable by some amount. Okay. Now, for some reason, during the year, the company is also informed, or the customer that went bankrupt actually can pay you back, because of the proceeds received from liquidating all the assets. So when the customer pays back what was written off, what you need to do is to reverse the write-off journal entry by debiting accounts receivable by some dollar amounts, allowance credit by some dollar amounts. And since you are receiving cash from the default customer, you are going to debit cash and reduce accounts receivable by the same amount. This is basically the sequence or the process with respect to the adjustments on the accounts receivable. Hopefully this helps.
So like, if the example would be that in a scenario where you did, for whatever reason, what's it called, debit revenue again, you would count revenue twice because you would count revenue here and then in the beginning, right? That's why this is kind of the way it's done. That makes sense.
Hold on. So you're saying you are reporting a revenue twice?
I mean, I'm saying if you did it, like if you did this kind of wrong, where you if you like, I guess like if you consider this kind of revenue, you would count it twice.
I'm not reporting any revenues here.
No, I'm saying like if this was done incorrectly.
Incorrectly.
Like this, if this was done incorrectly, you like this would like for whatever circumstances record revenue twice, because you would record revenue when it was made, and then this would be like incorrect revenue.
Oh, that's a difficult question. I mean, if you are saying that you're recording a journal entry incorrectly, I don't know how to respond to that.
It's okay.
Yeah.
Just a question, but it's fine.
Yeah,
cool.
But again, the scenario or the story that you will see in the real world is that first you're going to be estimating the sum collectibles, okay? And in the next year, the company finds out that certain customer goes bankrupt and the company will write off, okay, that on collectibles. And sometimes the company finds out again that this customer who went default can actually pay back because of this proceed that the customer receives from liquidating the assets. And in that case, you're going to reverse the original write-off journal entry and then record this cash receipt journal entry. That's the whole sequence here. Okay. Any other questions?
Professor.
Yeah.
Is the number y has to be smaller than the number x?
No, it can depend on the transactions. The number will be provided in the exam. Okay.
If we do the problems in the book, it'll take us through the whole sequence, right?
Yeah, it will definitely provide you the proceed amount or the amount actually collected. Any other questions? Okay. I do not think this is important. So when writing off an uncollectible accounts, so this is basically write off example. Let me just go up. Where is it? So when the company writes off, the net accounts receivable or the assets stays the same. That's what this question is basically talking about. When writing off an uncollectible account, total assets remain unchanged, okay? Because you're basically reducing top portion and the bottom portion by the exact same amount, okay? So in the first part, we talked about contra revenue accounts and journal entries. So we talked about sales revenue, sales returns, sales allowances, and sales discounts. In the next part, we talked about this uncollectible items with respect to this accounts receivables and the whole process of estimating, writing off, and actually collecting what was written off previously. Now, in the next part, there are so many things. So in the next part, we're going to talk about this estimation. So the example we provide was basically given. Oh my God, what's going on? So we're basically saying, for example, 30% of the accounts receivables are not collectible, 20% of the accounts receivables are uncollectible, but there are different methods to estimate the exact collectible amounts. And we're going to talk about them going from slides 37. Okay, but for now, let's take a 20-minute break because we covered a lot of stuff. So yeah, 20-minute break at this point might be good. Okay, so we're gonna come back in at 8 o'clock. Yeah. Just stop the video. Okay, why don't we resume our lecture? But any questions before we move on to the last part? Okay, so like I said previously, so far we talked about estimating uncollectibles, writing off the accounts receivable, and collecting money that was previously written off. So these were the focus for the past several minutes. Now, in the next part, we're going to talk about the models, the method for this estimation of uncollectibles. So the example that I briefly discussed about this 30% of accounts receivables or 20% of accounts receivables, but there are many methods to actually estimate this allowance, okay? Let me draw a table here, okay? So percentage of receivables. So the easiest way is this percentage of receivables method. So what that means is that at the end of the year, you will have some accounts receivable dollar amounts, okay? So with that dollar amount, you're going to multiply that by, for example, 30% or 20%. In order to calculate or compute this allowance dollar amounts, okay? Now, on the other hand, we have another method called aging method. Now, what that means is that older accounts receivables are less likely, okay, less likely to be collected, okay? Collected. So for example, you have an accounts receivable that's pretty fresh, for example, 30 days out, compared to another accounts receivables batch that's over like 120 days old, okay? I mean, obviously, this has a higher likelihood of receiving the cash collection compared to this older accounts receivable. And that's why we call it this aging method. Okay, this aging method considers the age of receivables, and it is more accurate than using a single percentage, which was this. Okay. But at the end of the day, regardless of what method you're going to be using, the journal entry is basically the same. You're going to debit bad debt expense, okay, bad debt expenses, and credit allowance for uncollectibles by the same dollar amounts, okay? It just, they are two different methods to estimate the dollar amounts, but at the end of the day, the journal entry will be the same, okay? Now, another thing that we didn't talk about is that these two methods calculate, oh my God, or these methods calculate, this is important, the ending, okay, the ending balance of allowance, okay? Now, what that means is that so far, we assumed that the year one is the first year of the company's operation. In other words, the beginning allowance was 0, okay? But in the real world, companies are usually older and they are just not the new companies. So a lot of the cases, you have some beginning balances. For example, let's say you have 30 beginning allowance. So what you are calculating using this percentage of receivables method or aging method is the ending balance of allowance receivables. So which method you use, you will end up having this ending allowance method. For example, let's say you have 60 here, Okay. So in order for the journal entry that you are going to be recording at the end of the year is the change. Okay. So in this case, the bad debt expense will be 30 and allowance for uncollectibles will be 30. It's not going to be 60. Okay. That's something that's very important that you have to keep in mind of. Okay. Any questions on this?
But you're reducing the allowance because you're writing off, you're realizing that you're not collecting 30 of the 60.
No, actually, so you have some beginning balance or allowance that's estimated to be uncollectible. What you are calculating here is the ending balance of uncollectibles, estimated uncollectibles, which was 60 here. So for the journal entry that you're recording is that you're not going to be using this 60, but you're actually using this 30.
Oh, you're adding to, you start with 30 and you're adding 30 to it.
Yeah, adding 30 to have 60.
Oh, all right.
Okay.
Yeah, sorry.
Or I can use another number here, 70. Maybe this is better. So if your ending allowance is 70, your journal entry should be 40.
Yeah, you're just starting somewhere, you're adding to the allowance, and I guess it's the realization that the debt is going bad.
Yeah.
It's the actual write-off.
It's the actual. This is not write-off. This is estimation.
Okay.
Yeah.
It's the allowance.
It's the allowance. Yes.
And then the next step is the actual write-off.
We're not going to the write-off section process. Again, this section, this slides 38 going forward, is focused on the method of estimation. We don't care about this write-off. We don't care about.
Then what's bad debt expense?
Bad debt expense here. So when you're estimating the uncollectibles at the end of the year, the journal entry you're recording is debit bad debt expense and credit allowance for uncollectibles.
Okay, but the actual write-off is different than.
It's actual write-off is different. It's a different type of story. Okay. So again, we are focusing on the method of estimation, and we have two estimation method here: percentage of receivables method and aging method. Now, what they are doing, or what they are showing you or providing you, is the ending balance of allowance. So if your beginning balance of allowance is 30, and what you have on ending balance of allowance, let's say, for example, 70, for journal entry, you're going to be recording the difference, which is 40 right here.
Are these all balance? These are balance sheet items. So
these are balance sheet items, yes, except this.
Bad debt expense.
Yeah, this is an income statement item.
All right, so let's think about this. That reduces your income.
Yes, that reduces your income.
Thank you.
Any other questions? Okay.
Question.
Go ahead.
Is this the way to calculate bad debt expense?
Yes.
Okay.
So again, go ahead. Oh, I guess not. So again, these two methods, percentage of receivables method and aging method, what they are showing you is the ending balance of allowance. Okay. So for the journal entry, you are going to be recording the difference. Okay. So what if I use a T account, you have an allowance here. Okay. You had a beginning of 30, and then using these two methods, you have 70 ending balance. So in order to record the journal entry, you're recording the difference here. Okay, 40. Okay. So let's use examples provided here. So here, the company expects that 10% of the accounts receivables that are not yet due are uncollectible. Okay. So here you have $60 million that are not yet due, but out of 60 million, the company expects that 10% of 60 millions are not uncollectible. are uncollectible. So that's 1.6 million. Let's say $9 million of accounts receivables. They're due from within 60 days, and they expect that 30% of this category is not uncollectible. If it is older, so let's say if the accounts receivable of $4 million, they're past due over 60 days, between 60 to 120 days, half or 50% of that is not collectible. If it is more than 120 days, 70% of it is not collectible. And this is very realistic, right? The older it gets with respect to the accounts receivable, the more likely that the company is not going to be able to collect that accounts receivable. So if you sum these numbers up, you have $7 million, okay? So do I have the beginning balance? We don't have beginning balance. So in this case, using this example, let's assume, okay, that the beginning allowance was $3 million, okay, $3 million. After calculating the allowance, it was $7 million. So for the journal entry that you're going to be recording is bad debt expense of $4 million and allowance of $4 million. Okay. Again, you are starting with $3 million. You end up having $7 million at the end of the year. So for the journal entry, you're recording the difference of $4 million. Okay. Here. Do I want to go into more in depth? Actually, I do. So this is the aging method. Percentage of sales receivables method is basically the same. So let's say this is the total accounts receivable, $30 million. Let's assume that out of 30 million, 20% is uncollectible, okay? That means 6 million is not collectible. So you have a beginning of 3, your ending is 6. So for the difference, you're going to be recording bad debt expense of 3 mil and allowance of $3 million. Okay. So let's go on. So for percentage of receivables method and aging method, what you're getting after the calculation is the ending balance. But in the real world, I don't want to say the real world, but there are other, okay, other methods. Let me appendix. So there's another method called the percentage of sales method. Okay. So for the sales or the percentage of the sales method is that so far we have been talking about from the perspective of accounts receivables, but it is also possible that you estimate uncollectibles. Let me use estimate uncollectibles based on the sales amount, okay? Based on sales or revenue, okay? So this takes a different approach. So far for the percentage of receivables method and aging method, you are basing your estimation on the accounts receivable. But for another method called the percentage of credit sales method, you're estimating your uncollectible based on the revenue or the sales amount, okay? Now, the difference between the receivables method versus the sales method is that for for the receivables method, you are calculating the ending okay, ending balance of your allowance, okay? Whereas for the percentage of sales method, you are actually calculating the change, okay? Change in allowance, okay? So I think yes, the example is provided here. Let me go up a little bit. So let me draw a big table. So let's first use this percentage of receivable method. According to this, 20% of accounts receivables are not collectible. Okay, so at the end of the year, you have $30 million of accounts receivable. Okay, and out of 30, you expect that 20% is uncollectible. So that means you have $60 million of estimated uncollectibles. You have, so, and then assuming that you have a beginning balance of 2, okay, you have a beginning of 2, ending with 6. From this calculation, your journal entry is bad debt expense of 4 and allowance 4. Okay, this is what we have been doing so far. Okay, now for the percentage of credit sales method, let's look at this. The company expects that the 10% of credit sales is not going to be collected. Okay, so the information provided is that the company made $80 million of sales. Okay, out of 80 million, 10% is not collectible. So that's $8 million. Okay, and again, this is not the ending balance. Okay, this is not. This is the change. So for the journal entry you're going to be recording is bad debt expense, $8 million, and allowance, $8 million. Okay, so for calculation per se, percentage of sales method, it's much easier because you don't have to go through this change process because the calculation itself presents you with a change in the allowance amount. But whereas for the percentage of receivables method, you have one more process to get this number 4. Okay. Any questions between these two methods? No? Okay. So again, what I'm emphasizing here is that the percentage of receivables method or the aging method uses accounts receivables as a basis for estimating the allowance. And for these two methods, you're calculating the ending balance of your allowance. Okay. And for journal entry, you have to, again, calculate the change during the year. Whereas for the percentage of sales method, the number you're getting out of your calculation is the actual change amount. So you don't have to go through another step, okay? So you just directly use this $8 million to record a journal entry, okay? So there are many types of ways to, or method to estimate the uncollectibles, okay? Let me go up a little bit. So this was the aging method. So assuming that you're starting with 6, okay, you're starting with 6, and based on the, you're starting with 6 and your ending is 7, okay. Oh, you have a write-off in between. So if you have a write-off of 4, you are starting with 2. Okay, that means during the year, you have to record a 5 in order to address the difference. Okay, bad debt expense 5, allowance for uncollectible 5. Okay, any questions on this? Okay.
Is there a difference between sales or credit sales, or is that the same thing? Or does credit sales imply like bought on credit?
What do you mean? Here in this method, this percent of sales method?
Yeah.
Oh, it's definitely credit sales. If it is cash sales, there's
It's
nothing
not
to be
total
uncollected.
sales. Okay.
Yeah, it should be a credit sale.
Okay.
Yeah. Any other questions? Okay. So in the balance sheet, you have accounts receivables of 30, and you have a contra asset account called allowance by 7. So you have a net accounts receivable of 23. We talked about this previously. Okay. Now for the bad debt expense, you have a revenue, and under expenses, you report this 5. And then after subtracting all these expenses, you end up having net income of 25. Okay. When an entry is made to write off on uncollectible accounts, I think we talked about this. So when you're writing off, your net accounts receivable remains unchanged. Okay, we talked about this previously. Which of the following is true about the aging method? No estimate for uncollectible account is made. I mean, aging method is the way of estimating the uncollectible. So this doesn't make sense. Older accounts are less likely to be collected. And that's the point of using aging method. Older accounts are less likely to be collected. It's not acceptable. Aging method is falls under US GAAP. A lot of companies actually use it. Older accounts are, here you go. So older accounts are less likely to be collected. And that's an assumption under aging method. Okay. Contrast the allowance method and direct write-off method. Okay, so another layer of complication. So far, okay, using this allowance is an indirect method. Okay, indirect method. Okay, we are recording this allowance based on the estimation. Okay, we don't know the actual dollar amounts for the write-off. Okay, and that's why it's called an indirect method. And under the indirect method, we are using this estimated amount of allowances. But obviously, there's got to be a direct method. Okay, you only write off when it's certain. It's certain. Okay. So what that means is that let's use this. So under allowance method, okay, at the end of 2021, you estimate that $2,000 is not collectible. So if you estimate that amount, you're going to record this bad debt expense and credit allowance. Okay, this is an indirect method, specifically the allowance method. Okay. Now, in the following year, when the company realized that $2,000 is not collectible, the company actually writes off, and the journal entry for the write-off was the debit allowance and credit accounts receivable. Okay, we again went through this previously. Now, for the direct write-off, there is no estimation. You only write off when it's 100% certain. Sure. Okay, so at the end of year 2021, you do not make any journal entries because there is no estimation. Under direct method, you only write off in the year of a realization. So here you record bad debt expense of $2,000 and directly reduce this accounts receivable by $2,000. Okay, so any questions between these two methods? Okay, that's good. So the difference is basically the timing. Under the allowance method, this expenses is reported in year 2021. Okay, whereas for direct write-off method, you report expenses in the year when the actual write-off occurs. Okay, that's basically the only difference here. Okay, if you just cross these out, okay, basically the journal entry is identical between these two methods. It's the timing of an expenses that is reported, whether expenses are reported in the year of an estimation or in the year of the actual write-off. That's the only difference. Now, keep in mind that this direct write-off is not GAAP, okay? Direct write-off is used for tax purposes or some other rare occasions, but on the US GAAP, public companies are only allowed to use this allowance method. Okay. Any questions on this? Okay. So I don't want to go into details about direct write-off, so let's do the actual question. On December 31st, before adjusting entries, the company reports the following balances: accounts receivable of $100,000, allowance of uncollectibles, $2,000, credit balance. The company estimates bad debts to be 20% of accounts receivable. The adjusting entry would include. So let's actually get into the question. So you have an ending balance of accounts receivable of 100,000. Okay, the company expects that 20% of it is not collectible, so that's $20,000. Now, in the T account, you're starting with $2,000, and then you have an ending balance of $20,000. So as an adjustment, you're going to record the change of $18,000. So for the journal entry is bad debt expenses of $18,000 and allowance of $18,000. Okay. Any questions on this? Okay, so debit to bad debt expense, A, or credit to allowance, the numbers are not correct here, 18,000. So that was basically it. Sales discounts, sales returns, sales allowance. And then in the next part, we talked about the aging method and direct write-off method. And then next is notes receivable and interest. I'm going to skip this part for today because I think we covered a lot of stuff. I'm going to talk about this next week. Okay. But again, the sequence of the chapter is that we are starting with asset side. So far we talked about transactions related to accounts receivables, and below note accounts receivables, there are going to be notes receivables related transactions. That's the focus of part C, okay? But it's basically it. When the company lends money, you have some receivables to be paid back in the future, okay? And then you have some adjusting entries at the end of the year. But again, I'm going to talk about this next week when you're more comfortable with the accounts receivable and then sales part. Okay. So we talked about this, the percentage of credit sales method, the difference between the credit sales percentage versus the percentage of receivables was that for receivables, you're calculating the ending balance, whereas for credit sales method, you're calculating the change amount affecting the allowance. Okay. And we covered this. So let's get into the actual practice problems. Okay. So the company provides services on account to this hospital for $20,000. So this is an example of a sales discount 2/10 and /30. The company pays for the services on March 20th. So basically, the service was made on March 12th. The payment was made on March 20th. So that means the company is enjoying the discount. Okay. So let me just write a journal entry. So on March 12, okay, you are going to be recording accounts receivable of $20,000 and service revenue of $20,000. Okay. And on March 20th, okay, when the customer pays back, you are collecting cash of, let me just calculate, 20K times 98%. So that is 0.6K, okay? And accounts receivable will be reduced by the entire 2000K, and then the sales discount of 0.04K. Okay, this is the journal entry. Any questions on this? Okay, so it gets easier, right? So you are recording the original accounts receivable. Since the customer is enjoying this 2% discount, you're only receiving cash of 19.6K, okay? And then instead you're recording the sales discount of 0.4K.
Just to quickly clarify,
Sure.
we debit cash for 19.6, and then we debit sales discount for 0.4,
Yeah.
and then we credit accounts receivable.
Entire
Okay, just
20.
double checking, just because yeah.
Any other questions?
So the order doesn't matter. I mean, we can put a.
Oh yeah,
receivable
the
on
order
top.
doesn't matter. As long, I mean, based on this, you can easily tell these two are debit account items. These are a credit balance item because
Okay.
I indented basically to the right.
Do we have to put the 20K times 98% next to 19.6, or
In the
is that
exam?
just, yeah.
Oh no. You only need to put this. Oh shit. You only need to put that number, 19.6.
Okay, thank you.
Mm-hmm. Any other questions? Okay, next. During the first year of operation, this company provides services on account 150K. By the end of the year, cash collections on these accounts total 120. Blue Construction estimate that 20% of the accounts receivables will be bad debts. Okay, so given this example, okay, from the services on account 150K, you actually collected 120. So at the end of the year end, okay, you have 30K of accounts receivable, right? So out of 30K, you estimate that 20% is not collectible. So that's $6,000 of allowance. And since this is the first year of operation, that means your beginning balance is 0. So you can easily write a journal entry, which is bad debt expense of $6,000 and allowance of $6,000. Okay. Any questions on this? Very easy, right? And the follow-up question is calculate the net realizable value of accounts receivable. So net value. So your original accounts receivable was $30,000, okay? And you have an allowance of $6,000. So your net accounts receivable is 24K. Okay. Next, the company has the following balances before any adjustments. Accounts receivable 60K, allowance for uncollectible $2,000. On December 31st, the company estimates 20% is not collectible. Record the adjustments. So let me do this. So accounts receivable, you have 60K. Out of 60, you estimate 20% to be uncollectible. So that means 12K is not collectible or reported under allowance. And under allowance, you're starting with 2K, okay, balance. Your ending balance is 12K. So the difference is 10K. So for the journal entry, you're going to report bad debt expense of 10K and allowance 10K. Okay. Now it gets easier, right? As you practice more and more. Determine the amount at which bad debt expense is reported in the income statement. So in the income statement, you are going to report $10,000 as an expense. Allowance for uncollectible accounts, we have $10,000 reported in the balance sheet. Calculate the net reserve value of accounts receivable. So again, you have the original $60K for the allowance. Now for accounts receivable, you have allowance of $10K. So your net accounts receivable is $50K. Okay. What students usually make a mistake is for this part is that you have $60K, you calculate this $12K, so they just assume that your net accounts receivable is $48K, which is not correct. Okay, again, what you're calculating here is the ending balance. Okay, so you have to do this T account to calculate the change, and that's what's being reported here. Correction, I made a mistake. Correction, I made a mistake. So let me just erase that. Oh, the computer froze. Okay. So the journal entry is correct. So you are reporting bad debt expense of $10,000 and allowance of $10,000. Okay. Now, your net accounts receivable is, okay, 48K. Now, let me just explain quickly. Let me go down. So you have the original 60K of accounts receivable, okay? At the end of the year, basically your ending balance of allowance is 12K. Okay, allowance. So your net accounts receivable should be 48. My mistake previously. Okay. So your journal entry says allowance is reported 10K, but your net accounts receivable should use this ending balance of 12K. Okay. Any questions?
I actually have a question about a previous practice set on 63. I'm just curious as to where you got the 98% from.
So since the customer is paying back within 10 days, okay, the customer is enjoying 2% discount. So if you're enjoying 2% discount, what the company is receiving is the rest, 98%.
So 2/10 means?
So 2/10 means if the customer pays within 10 days, they are receiving 2% discount.
Okay, thank you.
No problem. Any other questions? Okay, so let me do this, page 66. So far we've been using the percentage of receivables method. In this question, the question is using the aging method, okay? So you have these accounts receivables broken down based on the age group. So let me just calculate quickly. So out of 50, 10% is uncollectible. So that's $5,000. Out of $11,000, 20% is not collectible. So that's $2,200. Out of $6,000, 50% is not collectible. So that's $33,000. Out of 3,000, 90% is not collectible. So that's 2,700. So if you add all these, 5, 10, 13, you have 13,900 ending, okay, allowance.
I think it's 12, Professor.
What was that?
It's 12.
It's 12?
Yes.
Oh, yeah, you're right. Sorry. There you go. 12. Okay. So using T account, you're starting with 2,000. Okay, you are starting with 2,000. Your ending is 12,900. So the difference is 10,900. So for journal entry, you're going to report bad debt expense of 10,900, allowance, same amount, 10,900. Okay, so estimate the amount of uncollectible receivables. So that's this. Okay, the ending balance of allowance 12,900. Record the adjusting entry, which it was this. Calculate the net realizable value of accounts receivable. So your original accounts receivable totaled 70,000 here. 70,000. Your allowance is 12,900. So your net accounts receivable is 57,100. Okay. Any questions on this? Okay. Very good. So I guess this is the last. Company reports the following amount at the end of the year. Sales was made for the amount of 300,000. Accounts receivable 50,000. Allowance was 1,000. Record the adjustment for uncollectibles using the percentage of receivables method. And the other question is asking using the percentage credit sales method. So let me just quickly compare these two methods. Okay. So you have a percentage of receivables, you have a percentage of sales. Okay, so let's start with the receivables. You have an accounts receivable of $50,000. The company estimate 10% of the receivables is not collectible. So that's 5K. You're starting with 1,000. Your ending is 5,000 coming from this. So the journal entry is bad debt expense by 4,000, allowance 4,000. Okay. Now using the percentage of sales method, you're starting with 300,000, multiply that by the 2% of the credit sales will not be collected. So 2%. So that's 6,000. Okay. Now you don't have to go through this T account because this 6,000 is the change. Okay. So for the journal entry, you're going to record bad debt expense of 6,000 and allowance 6,000. Okay. Calculate the effect on net income and total assets in the year for each method. So on the income, on net income, because of this $4,000 of bad debt expense, net income will be reduced by 4,000. Using the percent of sales method, net income will decrease by 6,000. Okay. Now for accounts receivables, okay. For accounts receivables, you originally reported 50K, okay. You report 4,000 of allowance, that's 46K net amount. Under percentage of sales method, you still have 50, your allowance was 6. So use 6, so that's 44. Okay. Again, I made a mistake. So this is very important. So this is not 4. Just because you see 4 here in the journal entry, okay, does not mean you're going to use 4. You should use 5. Okay, so just erase that. You subtract 5, so that's 5. 45. My apologies for keep making mistakes. And this also applies here. So even though you're using the credit sales method, the percentage sales method, your change is 6,000. So what that means is that you're starting with 1,000, your change was 6,000. So your ending is 7,000 actually. So instead of reporting 6 here, you have to report 7,000. There will be 43K right here. Okay. So be careful with calculating the net accounts receivable.
So those net incomes would be 5,000, 7,000 respectively?
Oh,
Or
so net income, yes. So for this here, net income will be 296K. In this case, net income will be 294K. Okay. Any other questions?
Yeah, quick question.
Mhm.
For the percentage of sales method,
Yeah.
so you don't have to necessarily worry about the beginning balance and the allowance for uncollectible accounts,
True.
or the beginning credit balance for the actual adjusting entry, but then to calculate the, I guess the effect on net income you
Yeah.
do. Okay, cool. Thank you.
Mm-hmm. Any other questions? Okay, so we covered a lot of stuff, okay? So make sure you go back to your textbook and try to do as many practice problems as you can. I mean, as you can see, like what I did here, I make a lot of mistakes, especially with calculating the net accounts receivable. So the only way that you do well on your exam or quizzes is to practice as many, as much practice as you can to be more comfortable. Okay. So with that further ado, if we don't have any questions, we have an extra credit presentation.